As a final trading day for the week, welcome to Business Morning. I'm Esther Ubodaga. Thank you so much for joining us on day 2 of this week's capital market public hearing into the state of the capital market, or the near collapse of the capital market, if you wish. Went on relatively drama-free yesterday at the nation's capital in Abuja, where more stakeholders took the stand to make presentations, giving their thoughts on the state of the capital market. And one common denominator was a call for better regulatory oversight by the market regulators. We'll continue to track those proceedings and give you more details as we get them. It will also be our focus for today. And joining me later on the program will be Wale Oluwo. He's the CEO, that's the Chief Executive Officer of Investment Banking at BGL Group. We'll be looking at some of the issues that have been raised and, of course, reactions that have been trailing the capital market probe. Well, as the final trading day of the week, stock markets across the globe have been shaping up. Let's go straight to the Asian bourses. Let's see what the numbers look like this morning. Shares are down for a second straight day. We had investors reacting negatively to the U.S. jobs data that came out about 2 days ago. And there's another key one coming out later today. That's the non-farm payrolls jobs report. That's looking at the number of jobs that were created outside the agricultural sector in the U.S. We saw that also impacting on the numbers. Let's take a look now. The Nikkei 225 in Japan managed to stay afloat, up 0.31% at 9,380.25 points. The Hong Kong, that's Hang Seng Index in Hong Kong slipped, which Chinese property developers week following China Vanke's results, renewing fears about the sector central to the state of the world's second largest economy. We saw the Hang Seng slipping down 0.72%. In China, the Shanghai Composite Index closed at its highest level since mid-March as traders rallied on the news of a meeting that will be held next week on financial innovation for brokerages. That lifted sentiment at the market, tipping the Shanghai Composite Index up 0.49%. The ASX 200 in Australia slipped this morning, pulling back from this week's 9-month high as investors sold mining-related stocks on worries about waning demand for commodities on signs of slower global growth. So mixed numbers there. That's pretty much what it's been like for the Asian markets this week. Right from Monday up until now, we've seen mixed numbers across the board, but those gauges, they have managed to stay afloat. So that's the Shanghai Composite Index and the Hang Seng Index, but it slipped this morning. The ASX 200 has been mostly in negative territory and is down this morning once again at 4,396.04 points. Let's cross over to Europe. Let's see how Europe is shaping up in early trade. Top shares in the region are currently shedding weight ahead of the U.S. jobs data and a potentially volatile weekend for European politics. We'll see, of course, there will be the elections in France and Greece. That is putting investors on the edge, and we're seeing them trading very cautiously at the market right now. Bank stocks are among the worst performers so far and are being weakened as a result of the very bearish numbers from PNB Paribas, one of France's top banks. The bank's first quarter profit fell about 1.2%. Now, that disappointed investors, and we're seeing bank stocks taking a hit as a result of that. The FTSE Euro First 300 index has lost about 5.27 points so far. That's also what we're seeing affecting the market. So it's red numbers for the European bourses this morning, but of course trading continues for Europe for the next couple of hours. Well, let's cross over to the other side of the Atlantic. Let's take Wall Street numbers from yesterday. The same sentiments still brewing at the markets. That's the jobs report. Investors had actually been optimistic ahead of this report, but when it came out, that's the weekly jobless claims data that dampened sentiments. The Dow Jones fell yesterday, down 0.47%, brought down by Bank of America and HP, which lost about 1.96% and 3.05% respectively. Now, most key S&P sectors also closed in the red, led by energy and material stocks, while consumer staple stocks managed to squeeze out small gains. The gauge raised about 10.7 points or 0.77% to finish at 1,391.57 points. That's for the S&P 500. The Nasdaq also shed some gains yesterday, coming down about 35 0.55 points or 1.16% to end at 3,024.30 points. Now, the CBOE Volatility Index, which measures sentiment at the market, also closed above 17 yesterday, showing that investors that are not particularly happy right now with the numbers. Now, let's move over to our own markets down. Here in Nigeria, the rally at the Nigerian Stock Exchange is still raging on, with the bulls very much in control. Bank stocks were in the forefront of the rally, and it's not unconnected to the very robust earnings that we've had in the last couple of days. That's from the banks. We had some new ones coming out yesterday, Zenith and Skybank. Now, before that, we had very robust and impressive earnings from First Bank, which reported very good first quarter earnings for the first quarter of this year. We'll go into that in the course of the program. Now, let's take full stock of the market. First Bank, UBA, that's United Bank for Africa, and Zenith led gains yesterday at the market with over 4% of gains. Of course, that's on the back of very impressive earnings put out by these three banks in the last week or so. Zenith, Skybank, as I mentioned earlier, released their earnings. Let's take a look at the best performers for yesterday. WAPCO is in the lead, moving up 5%, gaining about 1 naira 99 kobo and closing at 41 naira 79 kobo per share. First Bank also rallied yesterday, up 4.9%. That's a move upwards by 52 kobo, closing at 10 naira 99 kobo. Nigerian Aviation Handling Company also rallied yesterday, gaining about 40 kobo. That's about 4.9%, closing at 8 naira 8 kobo. Zenith and UBA also made the list. So we're seeing banks dominating the best performers or the gainers table. That has been the trend in the last couple of days, as more earnings are expected from this particular bank. So we're seeing bank stocks leading the rally at the market, and the market is seems to be paying no attention to the capital market probe that has seen, that has seen a focus on the banks or the banking sector, as you will. All the negative talk that has been coming out, talking about the market infractions and all that happened where the banks manipulated their share prices, all the infractions that we heard about from the banking stocks. But that is not affecting the banking stocks or the market in general. We're seeing the rally continuing. Last week, the market hit the 22,000 point mark, and the market capitalization is still firmly at the 7 trillion naira point mark. So it's been a very, very good run this week, and even from last week for the Nigerian Stock Exchange. Stocks are still rallying, not just the banks. Some other blue chips have also been a part of that rally. Well, later on in the program, hopefully we should be able to connect with David Andorin. He's a stockbroker who he will call live from the trading floor of the exchange to give us some early trading numbers. Well, of course, today we're focusing on the capital market probe. We've had 2 sessions this week where we saw a number of stakeholders talking about or giving their thoughts and making presentations on what happened when the market crisis started in 2009. We've had the deputy governor of the CBN, what's it called? I can't remember it at this point. Mr. Kingsley Mohalu, he gave his own presentation. We had also the managing director of the Asset Management Company of Nigeria, Mr. Mustafa Chike. That would be the financial system stability. That's Mr. Kingsley Mohalu. They made presentations. We had more stakeholders yesterday also giving presentations. That'll be our focus today, and of course we'll be expecting our guest Wale Oluwo to give us his thoughts on what he thinks or how he has been reviewing the process so far. We'll take a break now and we'll be right back. Welcome back to Business Morning. Today we're focusing on the capital markets public hearing on the near collapse of the capital markets. I will be expecting our guest for today, Mr. Wale Oluwo, the Chief Executive Officer, Investment Banking at BGL Group. He'll be here to give us his thoughts so far on that particular hearing. Well, let's go over now to our earnings board. Yesterday, Zenith and Skybank, two of the banks quoted on the Nigerian Stock Exchange, released their first quarter earnings for this year, and numbers are quite good. Let's take the Zeniths right now. Gross earnings came in over 33.4% at 72.3 billion naira. Profit before tax also came in quite high, up 25.4% at over 23 billion naira. Profit after tax also came in high at 19.2 billion naira. That's an increase of about 26%. Net assets are also up 5.6%, and then at 397, that's 397.8 billion naira. Zenith also made the top 5 best performing stocks table yesterday, gaining about 76 kobo yesterday. Let's take Skybank's earnings. First quarter of this year, gross earnings came in at 27.8 billion naira. That's a 12.6% increase from 2011. Profit before tax, however, declined marginally by 4.6%, coming in at a little over 4 billion naira from 4.2 billion naira in 2011. However, profit after tax went up 2.3% at 3.4 billion naira from 3.397 billion naira in 2011. Net assets are also up 3.9% at 114.9 billion naira. Well, before then, we've had a couple of banks also releasing their first quarter earnings, talking about GT Bank, First Bank. Now, so far, First Bank has reported the most impressive, most robust first quarter earnings so far. Let's quickly remind you take a look at some of First Bank's numbers for the first quarter of this year. Gross earnings came in up 42.5% at 92.2 billion naira. Profit before tax surged significantly, over 100% increase at 28.8 billion naira. Profit after tax also came up very, very significantly, up 101.6% at 24.5 billion naira. Net assets are also up over 2% at 363.6 billion naira. Very impressive results from these banks that have been in the forefront in the last couple of weeks of market recovery. Now, these banks are the same banks that led the markets to the downside a couple of years ago when we had the market crisis. So there had been mixed doubts as to whether or not these banks would eventually recover. But looking at their balance sheets now, it's obvious that the banks are actually back to liquid ways or winning ways, as it were. The balance sheets are looking very much stronger. Investors seem to have more confidence in these banks, in their bottom line, and we're seeing that being reflected in the way the stocks have been moving up. Last week, the banking index was up over 4% in the last couple of days, right from Monday up until now. It's been gaining close to 1%. Yesterday was actually up over 3%. So it's an indication that investors' confidence has indeed returned, especially as concerns the banking stocks so far. Well, of course, we'll continue to track it, and of course, we'll be tracking the events at the Capital Market Probe also. Let's go over now to the money markets. That's the financial market indicators for Thursday. Lending, as a cost of lending among banks, fell yesterday by about 2% across the board. That's for both the short and the long-term lending. We saw call money closing at around 11%. The secured open buyback rates for discount banks and discount houses also fell about 2%, coming down to around 11.9% on average. At the currencies arm of the market, the naira slipped marginally after rallying in the last couple of days against the US dollar, especially at interbank foreign exchange market. We saw the local currency closing yesterday at 157 naira 40 kobo to the dollar. Well, we do know, according to market traders, the market has been relatively liquid. That's talking about a dollar supply. We've had the supply from local units of multinational oil firms that have been providing dollars to the market, coupled with the CBN's bi-weekly foreign exchange auction. The Apex Bank has also been doing all it can to ensure that the market is relatively liquid and that the naira does not go back to being very volatile. So we're seeing some stability in the price of the naira. We've also had some liquidity coming into the market. That's for the interbank markets. We had at the treasuries market, we had some bills from the open market operations coming into the market. That's also known as maturing bills. We had 160-day money that was yesterday, 160-day cash at 17.9 billion naira. That's the amount that was auctioned by the central bank, given at the rate of 16%. We had 163-day tenor worth about 31.2 billion naira, given at the rate of 16.4%, and a 135-day tenure worth about 39 billion naira, given by the CBN at about 16%. That's over 80 billion naira that came into the market, but that didn't particularly impact on rates. Of course, we know that usually money or cash flows out into treasury bills purchases and foreign exchange purchases. That, of course, impacts on the numbers. But the OMO, that's the open market operations, is one of the monetary policy tools used by the Central Bank of Nigeria to help lenders in the country manage their cash and, of course, to generally ensure that there isn't too much money running around in the economy. Well, we're still focusing on the capital market probe. We'll take another quick break now and we'll be right back with the rest of the program. Please join us again.
I was appointed.
Welcome back to Business Morning. The hearing into the state or near collapse of the capital market commenced on Wednesday this week with major presentations by the CBN's Deputy Governor of Financial System Stability, Mr. Kingsley Moghalu, the NDIC boss, Mr. Umaru Ibrahim, and also presentations from the Managing Director of the Asset Management Corporation of Nigeria. It promised to be a very, very interesting session. Let's just play you some parts of that particular session on Wednesday.
I was appointed to create an organization that will very quickly address a looming problem. Another thing that nobody has mentioned here is that all these banks, 8 of them, were losing an average of 2 billion naira a month. So every month you waited, you had a 16 to 20 billion naira additional problem on your hands. The reason why they were losing 2 billion a month was they all had negative equity. To fund their operations, they were borrowing money in the interbank markets at 16% to fund their operations. No bank could survive with that. So it was a ticking time bomb to liquidation. The longer you waited, the bigger the problem became. So when we came on ground, we had no employees, we had no offices, no cars, no infrastructure. And we had to buy all the non-performing loans from the banks, the failing banks, by the end of the year 2010 because of accounting issues. So we had 6 weeks. We operated out of temporary offices. We had no staff. The 4 executive directors worked 18, 20 hours a day to make sure that we bought these loans by December 31, 2010. And that's what happened. So we came to fix a very urgent problem. It was not useful for the authorities to explain to the public the size of the problem because it will just create panic. A situation where you're losing across all the banks every month, they're losing 20 billion naira. So when we talk about central bank and its deadlines, Central Bank was aware that the problem was worsening every month by 20 billion and something had to be done. This crisis occurred 2009. Banks were given 2 years to recapitalize. The first deadline was June 2011. 2 years that these banks were given to capitalize. When they couldn't do it June 11, it was extended to September 30th. That was a second extension. When somebody has spent 2.5 years trying to recapitalize a bank that's worsening by 2 billion a month, it's difficult to say give them more time. It's difficult, it's irresponsible, it's impractical. So this was a ticking time bomb. And when people talk about lack of confidence in what happened, they don't understand what could have happened if that hadn't happened. If you had allowed 1 trillion naira of deposits to go into the air, much of those deposits were to other banks. So some of these so-called healthy banks would have had to lose a lot of money immediately those banks got liquidated. So it's a complex thing, and you make the best judgment you can. You make it in the best interest of the major people. We talk about 50,000 investors. We have 10 million depositors. And when these depositors go to the banks, when a depositor goes to the bank and hands them their money, they expect to get it back. Investors should not think like that. Investors should not believe that when they go and they make an investment in an institution, that they must get their money back. And no government should entertain the idea that investors who take risk, who get upside, should not be subject to downside. If government starts doing that, where are we going to stop?
Market discipline and confidence. But we had to embark on it at the time we did. And like I said, it was done orderly, it was multiple, it was not easy. But at that time, the issue of bridge banking, to my recollection, was never advanced by any jurisdiction anywhere in the world. So it was a recent development. And because of our interactions with the Federal Deposit Insurance Corporation and many other international players, we came up with this issue of bridge bank, which, by the grace of God, the National Assembly appreciated and allowed us to insert in our revised act. And like we said, this has helped in very many ways to engender confidence and to protect our depositors. Taxpayers' money, is not directly involved. NDIC did not, invest a kobo in it.
Going forward, I believe that's one of the whole points of this discussion. What are we doing about the future? Let me talk about what we're doing about the future. First of all, the central bank, the SEC, and other PENCOM, NICOM, all the other financial regulatory institutions, we have strengthened the Financial Sector Regulatory Consultative Coordination Committee, the FSRCC. We meet every other month, heads of all the agencies, and we bring our heads together to compare notes on our supervision of the various aspects of the financial system that we are each regulating. We combine to create a framework that brings about coordination between us as regulators. Currently, the central bank is undertaking a major exercise to establish a macro-prudential regulatory framework for the banking system. And we will work in coordination with other regulatory agencies and the Ministry of Finance to establish that framework. We're working to set up a banking sector crisis resolution framework. What we did the last time, we did on the fly. We reacted as the events were happening. But we now know that we have a responsibility to build future and forward-looking architecture to deal with banking crisis.
Well, these were the major presentations made by the Asset Management Company of Corporation of Nigeria's Managing Director, Mr. Mustafa Chikeobi. According to him, the actions taken by AMCON back then were absolutely necessary. He said when the NDIC approached AMCON with the bridge bank, AMCON had no choice but to take over these banks and put money into them. According to him, the banks were losing over 20 billion naira every month and posed a very, very dire systemic risk to the entire financial system. He said they were actually given 2 years to recapitalize, and after that 2 years they were unable to do so, and so AMCON had to take over. He said the banks affected were a ticking time bomb, and if the regulators hadn't intervened, over 1 trillion naira would have just gone into thin air. That's according to him. Now, according to Mr. Kingsley Moalu, the Deputy Governor of Financial System Stability of the Central Bank of Nigeria, he says, well, the regulators were also culpable in their own right, and that they're actually doing more now to strengthen their supervisory and regulatory strength to ensure that that doesn't happen anymore. They said that they're putting a number of measures in place to ensure that the financial sector does not experience that particular crisis. Well, he did say that the sector is not particularly or completely immune to this kind of crisis, or the crisis that happened back in 2009. But he says that now the regulators, particularly the CBN, are better prepared to handle another crisis if that happens. Well, that, of course, is still our focus today, and we're still expecting our guests to come look at that for us. Well, let's quickly just go back to our earnings board. We had one more earnings coming out from GT Assurance yesterday. That's one of the stocks listed in the insurance subsector of the Nigerian Stock Exchange. GT Assurance also rallied yesterday. We saw a positive response by investors towards the stock. Gross premium came in over 22.4% at 5.3 billion naira. A profit before tax also surged significantly, up 115% at 469.9 million naira. Net profit also came in much higher compared to what the insurance company made in 2011, up 199.8% at 376.2 million naira. Net assets are also up about 2.6%. Well, the Nigerian stock market has resumed trading for today, the final trading week for today. And from what we're hearing, the stocks are still rallying at the moment, led by banking stocks. So, of course, we'll continue to monitor that for you. The market doesn't seem to be paying any attention to the public hearing into the near collapse of the capital market. There have been fears that that might actually affect the confidence level at the market, creates perhaps fear and even uncertainty at the market, and that some investors, particularly investors who have put their money into banking stocks, may actually be so scared as to just wait on the sidelines, and we might have been witnessing a significant drop in banking stocks and some other blue chips, but we've been seeing the exact opposite. As a matter of fact, the market has been rallying, led by the same banking stocks. First Bank, Guarantee Trust Bank, Zenith, United Bank for Africa, First City Monument Bank, some of the banking 10, that's the 10 most capitalized bank stocks on the Nigerian Stock Exchange, have been rallying in the last couple of weeks. In the last 2 weeks or so, we've seen them pushing up the All-Share Index, which has now crossed that 22,000 psychological level of the market. It's over 22,500 points right now, and the banking stocks are the ones responsible for that. The market capitalization has also crossed the 7 trillion naira mark. So it's been a very good run for the market. We've seen the bulls still taking very firm control of the market. Well, it doesn't look like the market. Well, usually if this had happened in a developing or developed nation like the stock markets in Asia, Europe and America, numbers would have been very bearish, because investors would have been very skittish, very cautious, and we would have seen the numbers coming down. But the Nigerian stock market has been acting in a very, but it's all positive. That should be the most important thing at this point. We'll take another quick break now. We'll take on our guest, Mr. Wale Oluwo, the Chief Executive Officer, Investment Banking at BGL Group. And of course, we'll be looking at the public hearing into the capital market. Please join us again. Welcome back to Business Morning. Joining me now is Wale Oluwo. He's the Chief Executive Officer, Investment Banking at BGL Group. And we're looking at the proceedings that have been conducted so far by the House of Reps Ad Hoc Committee investigating the near collapse of the Nigerian capital market. Thank you so much, Wale, for being here. Now, we've had
after a long time.
Oh, yeah, it's been a while. It's been a while indeed. Now, it's been 2 sessions of the House of Reps Ad Hoc Committee investigating the state of the capital market. The first day, Wednesday, that was quite dramatic, very volatile. We had major presentations by the NDIC MD, Mr. Omar Ibrahim. We had AMCON boss there, Mustafa Chikiobi, and we had the CBN Deputy Governor of Financial System Stability, Mr. Kingsley Moalu. We also had more presentations yesterday, and of course, the theme of yesterday seemed to have been let there be more regulatory or stronger regulatory of oversight by the regulatory authorities. But just give us your thoughts generally so far for this week's hearing.
Well, I think so far so good. I like the way they have approached this assignment. Talking to stakeholders, and probably at the end of the day they will come back to SEC, which is supposed to be the apex regulatory institution. What is also striking is the fact that you cannot divorce the activities of the money market, that is the monetary policy framework itself, from whatever happened to the capital market. If the monetary policies did not weaken the capital market, it is already making it difficult for the capital market to recover. And I would not say it didn't weaken the capital market, because it was money from the money market that found their way into the capital market and created this excess liquidity that made people to begin to have the kind of valuation and pricing that were out of this world. Now, the fact that they have talked to CBN, they have only asked CBN a lot of questions as it related to, issues of AMCON, takeover of banks, nationalization. And all. They need to call CBN back to that committee and let them tell us if they understand at all how their monetary policy is impacting on the markets. It's not only the capital market. It's impacting on the capital market. It's impacting on the money market itself. And it has already created problems in the bond market, because as we speak today, the federal government is borrowing money at 15% and above. They are talking about crowding out, and the AMCON boss was saying crowding out may not happen until 2013. That is not correct. There is already crowding out, not by activities of AMCON, but by the activities of DMO, which is putting the federal government instruments into the market. And if the federal government is already borrowing at about 15-16%, that's the benchmark rate. Private sector institutions and state governments cannot borrow at less. And what have we seen in the capital market on the ability of state governments to raise money? A lot of them wants to come to the market, almost like 10 of them. They cannot come for the past 6 months, because why? Nobody wants to come to the market and raise money at 16-17%.
No, Wale, sorry, let me comment here. When Mr. Kingsley Moalu, the CBN Deputy Governor of Financial System Stability, when he made his presentation, he talked about back then when the whole so much liquidity coming into the market. He talked about high oil prices, that there was just liquidity everywhere, and the banks began to lend to non-priority sectors, especially the capital market. So now, what you're saying, the money market, monetary policies, but he said that it was this, high oil prices, the extra cash that came in at that period.
Everything is about balancing. You had excess cash, and you had overvaluation. Then you have limited cash, and you have gross undervaluation. That's why a lot of the stocks are trading at below their book value. And you heard what Imokwede said. A lot of these stocks are trading less than their book value now, particularly banks. And that's not healthy. It's not consistent with global trend. No matter how bad the economy is, stocks should still trade, reasonably at their book value. That's the challenge we are having. My proposition is this: let the CBN come back and tell us their understanding of how their policy is currently making the market not to recover, and how it is affecting other markets. Because, mind you, you cannot divorce the capital market from the entire economy. If the economy does well, the capital market will do well. The capital market, on the other hand, will also help the economy to do well. So they are interlinked.
Now, I was going to ask you, is this something the federal government can help? I mean, the federal government is embarking on so many infrastructure projects. They need to borrow every month, and the DMO is doing that on behalf of the federal government. So if the federal government is offering investors a 3-year bond with a 16% coupon rate, well, is that such a bad thing?
It's a bad thing. That's the truth. look, interest rate will drive a lot of things in the economy. And what is interest rate? It's the price of money. So if you say because of fear of inflation and because of fear of the foreign exchange market depreciation, you continue to keep interest rates at that high rate of 12%, the MPR, it's not going to work. And we've been saying this for the past 1 year. It's not sustainable. That is one. The CBN has already achieved what they set out to achieve, which was stability during the turbulent period. Everybody could understand that. But having achieved stability, you move to growth. And I believe that about 2 months ago, the IMF came out with an advisory position and told Nigeria there is no way you can increase this interest rate further. What we should be working towards now is for rates to start trending down. That is when people can have access to money, access to capital, and be able to continue to expand operations, and economic activities will grow. That in itself will have an indirect impact of inflation, because when goods and services increase, inflation will go down.
Let's go back to the beginning. Now, a lot of emphasis has been placed on why the crisis happened, who caused it, who's responsible for it. But it seems like it's the fact that at that same time, that was when the global financial crisis actually happened, and that a lot of fund managers who had investment here in the stock market or the capital market actually pulled out their funds at that time, which also contributed a great deal to the market downtrend. But it seems, or would you say that it's more of what happened here locally within our market, that's infractions, the banks, the sharp practices by the banks pushing up, falsifying or falsely pushing up the stock prices of their shares? Was it more of that, or more of the global economic effect on our market?
We have to dimension these issues. There are 3 issues here. How did we get here? Why are we still here? And how do we move out of here? I think those are the 3 issues. If you look at what caused this problem, the banks, we cannot say they were solely the corporates.
No, Wale, sorry to butt in. I'm asking that because we've had 3-4 sessions now, and there's always so much emphasis on who did this or who did what.
That's important for us to be able to locate the problems. And
but these are issues that have actually been brought up before, exactly. Especially during the period when it happened.
Exactly. The foreigners triggered it by taking money. But who created the bubble? The foreigners substantially did not create the bubble. That's the truth. The bubble were created artificially and unintentionally. Mind you, we never used to have pension funds reforms. Immediately those reforms happened and the PFAs were allowed to invest 25% of their funds in the market, that created a major inflow of liquidity into the market that the market had never seen before. Now, add to that the activities of international investors who were seeing those numbers and those opportunities, and they were coming in to take advantage of it. But the difference was that when the market was going up, we were all clapping, as if overvaluation is also not a problem, the same way undervaluation is a problem. Now, the banks saw that opportunity, and because they were awash with liquidity, more so, a lot of them were expanding their shareholders' funds and capital at that material time. When capital was 25 billion, most of them were already getting close to 200 billion. So a combination of all these factors moved liquidity in the direction of the capital market. And the capital market did not have any capacity to handle this liquidity. And we had those overvaluation, those bubble, and something must just give. Now, that is history. Where we are now is that the bubble is no longer there. We now have a challenge of how do we bring back the market? And I'm saying the way to bring back the market is that those who left the market must be encouraged to come back. That is one. Number 2, the international investors, in fairness to them, they've been coming back.
They're actually in fact, back.
They used to be about 20% of the market when the market was at its maximum. Now they are almost 60-70% of the market, so they're back. But the retail investors are not back. The institutional investors, they are not back. And they are not appearing that they want to come back at all. That is the challenge. Now, if that is the case, we must go back to the market itself. and begin to see what the problems are with the market.
So in terms of focus, would you say that this particular committee is focused? As I understand it, what happened to us then wasn't something that didn't happen to other stock markets across the globe. We all went down, talking about
yes, but Africa, a lot of them Asia, have recovered.
A lot of them have recovered, but we are not recovering. So what that should be, is that the main focus?
That should be
why
the main
we're not
focus
recovering.
of the market. No, the focus of the committee should be three. I said it earlier. How we got there, why we're still here for the past 4 years, and how we come out of here. So they must balance the three. But the real focus and attention should be, how do we come out of here? Because we must bring back the market. If you don't bring back the market, there is no way the economy can move at the speed at which we want it to move.
So many things have been done by the regulators, the Securities and Exchange Commission, the Nigerian Stock Exchange, restructuring the market, the new segmentation, the market, the listing rules, market makers, so many things. So what do investors, what is the average investor looking to see or have the regulators do? Because they have actually done a lot.
Yes, yes, they have done a lot, and they are still doing a lot. But we have isolated the problem into two broad categories. In fact, three: liquidity, confidence, and operational efficiency and transparency. Those are the three basic things they should focus on. On operational efficiency and transparency, they're doing a lot. On confidence, there's little they can do except to continue to make the market transparent, and people can decide whether to invest confidence in what they are doing or not. But now, with regards to liquidity, we have not seen much work in that regard. And that is the truth. The issue of the market makers is going to help us into bringing liquidity into the market. But the market makers that were appointed the last time, I'm not sure a lot of them are liquid enough to even make markets.
But the last 10 that were chosen recently, according to the NSE, actually met the minimum capital requirement and are actually supposed to take off.
They do. You see, the minimum capital requirement. The minimum capital requirement is 500 million. That is peanuts in this market today.
Well, isn't it something a stamp at least they're doing?
Yes, but the real intention is that they'll be able to leverage and be able to borrow and do all that. And more so, what Chike Mustafa Obi said the other day about security lending and all those stuff, they need to come back to the market, all those things. There must be a structure that can manage the debt of stockbroking houses. Because these are going to be participants in the market, and if they are substantially indebted, they are not going to be looking at markets, they are going to be looking at their survivor.
Okay, so
we must manage that.
While you've mentioned liquidity, are you talking about the debt overhang of stockbrokers?
The debt overhang of stockbrokers is an issue. The forbearance, I think they're working on it. I'm talking about the liquidity for the market makers. If market makers are not liquid, they cannot make markets, no matter how hard you try.
And that ultimately would affect the growth of the market?
Absolutely.
Is that also tied to market confidence for investors?
It ties to market confidence, but if we can achieve that, we also need to move to the next stage, which is market depth. The market must have depth, and it is market makers that put the market in a position to have depth, because people must be able to buy and people must be able to sell. And I will keep referring to the public hearing. Mustafa Chike Obi said they wanted to buy 4 billion naira worth of a particular. They wanted to sell 4 billion naira worth of a particular asset on the stock exchange. They couldn't sell it in days. That's not a market. A market that has no absorptive capacity. So that's why we are saying there must be debt. You see, if you have market makers, no matter the volume of stock you bring, the market maker must buy. And no matter the volume you want to buy, the market maker must sell to you. But
can't we start small? Okay, it doesn't have to be 4 billion. If we have maybe an amount lower than that, let's start somewhere. Let's get the wheels. Let's grease the wheels and get it. Get the truck moving, as it were.
Markets don't work like that. Markets don't work like that. But we will not get there in one day. I agree with you. But what is important is a market maker must have significant amount of capital and significant amount of leverage to be able to make markets. The second thing we should focus on is the securities lending. That must happen very, very quickly, because these are things that will make the market to come back. When you have the securities lending situation, then those artificial impediments in the market, we must begin to break them down. Like this circuit breaker of 5% for the entire market, 10% for market makers. Okay. There's no need for that. That is the truth. Let us have a market that is deep enough, that has layers. And let the market edge itself in an institutional fashion, not a market that we are edging artificially and stopping people from moving prices
you
up
think
and
perhaps
down.
the regulators are just concerned that things might just get out of hand if they don't cap it at that 5%?
That is a fallacy, and it's a fallacy to the extent that the regulators will say we are protecting retail investors. That's why we cannot allow stocks to move up or down. But you are not protecting retail investors. What you are doing basically is creating an artificial edge position in the market, which is unnecessary. When you remove that circuit breaker of 5%, 10% up or down, you must simultaneously institutionalize the derivatives market. They go together. So when you introduce derivative market at the time you are removing that circuit breaker, then you have a situation where the market will edge itself. I don't have to buy Nigerian brewery stock. I can buy an option on it. I can buy futures on it. I can buy swaptions. I can take a position. I can buy the underlying stock if I'm a long-term investor, and I won't mind because the underlying asset will convince me that it's a good investment. So that's why we are saying, if we can create derivatives market, and we believe that is going to be good for the market, and make this artificial circuit breaker unnecessary, why not? Why are we not doing it?
Okay, Wale, we are almost completely out of time now. Going forward, I know we still have a couple of sessions left. What are your expectations? And do you think that, you have said that the members are on the right path? They're actually focusing on what they
are. I'm impressed by the way they're focusing on handling it.
But do you think at the end of the day, perhaps aggrieved parties will be appeased? Because it seemed like there was a lot of focus on first, especially on Wednesday, on these nationalized banks, the shareholders who lost money from the three nationalized banks.
They were right to focus on the nationalized banks.
There are shareholders out there who are hurt, who are very aggrieved about the whole issue.
There's a question that has not been answered by the nationalized banks, and I think the House committee should focus on that. Okay. Well,
I'm sorry, we're almost completely out of time. We can't take that, but we'll definitely have you back here to continue. And of course, as proceedings continue, we'll continue to examine. But are you optimistic that at the end of the day, this probe will achieve what it set out to achieve? And perhaps we might see that trickling down to the capital market as regards, most importantly, when it comes to investors' confidence?
I think every day we hear them, invariably, I continue to build more confidence in their capabilities to be able to midwife this process. I think we should give them that chance. I think they're on the right path. If they don't derail, clearly we might. But it's not going to be an all-in solution. As they're doing their own, the Capital Market Committee must be doing its own to complement it. The regulators must be doing their job. For the past how many weeks? Anytime this committee is sitting, the regulators don't do anything. All of them go to the hearing and stay from morning till night. It's also not healthy for the market.
Okay, Wale, I'm afraid we're going to have to leave it there. Thank you so much for being here, for your contributions. I have been talking to Wale Oluwo. He's the Chief Executive Officer, Investment Banking at BGL Group, one of Nigeria's leading financial services institutions. We have been looking at the proceedings so far of the House of Reps Ad Hoc Committee investigating the near collapse of the Nigerian capital market. Well, that's about all we can also take on today's program. Thank you so much for being a part of it. I'm Esther Ubodaga. Have a great weekend.